Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me today once again is Chief Macroeconomist Lenore Hawkins of Tematica Research.
Good morning.
Lenore, thanks for coming back on the show. Where in the world are you this week?
Right, it's like in San Diego. Oddly enough, I am in San Diego this time around. And it's kind of a funny way that I started off my trip here. So yesterday, day before, Saturday, I'm in my garage and I because you can't go to gym or anything. So I have a Peloton treadmill and a bike, and I had to put them in the garage because I've run out of space. So I'm there working out, and I live right on the edge of a field in San Diego. So it's right, the San Diego Valley, where you can look down on the racetrack. Mm-hmm. And I see this very large mouse, which is a constant problem here because if you're right on a field, right, there's lots of mice. So I see this very large mice go running across the driveway because it's pouring rain out at this point. And the thing goes running across, and I'm clipped in to my bike. So what the hell am I going to do, right? Because he's coming in, and you don't want mice in the garage. So I managed to get out of the bike, which was not a pretty sight. There was some screaming, yelling, a lot of cuss words, and there was some falling, and it was not. Because if you have those stupid shoes, right, you can't exactly run around. Finally get the shoes off, and I go hunting all over for the mice. Can't find the mouse. Can't find him. I figure, well, maybe because he'd kind of gone behind my car, so maybe he'd gone back out, right? Because they're wily little guys. Mm-hmm. No such luck. Yesterday morning, I go out, and there he is. And that's when it began. Mano y mano, me and this mouse. At one point, the mouse was up on a shelf at about eye level, and I got my broom, and he's there, and I'm there. We were just staring at each other for like 10 minutes because I can't look away, right? If I look away, he's going to hide again, and I won't find him. And he's just looking at me. You can see his poor little heart. I don't want to scare the poor thing, but I need to get the damn mouse out of my garage. Needless to say, the entire process did not go very well. There was a lot of screaming. I'm sure I tried my neighbors. Did finally get him out of the garage, but by the time that was all said and done, the amount of dust I had picked up, and I'm really allergic to it. So this morning, I am Benadrylled and puffy-eyed and a little frazzled.
Perfect.
Of a guy about that big. At one point, he even jumped into my biking shoe.
That didn't go well. That didn't go. So you got the mouse out, but the mouse, I mean, he took his pound of flesh.
Oh my God, he did. And by the time I was done, because I'm, the garage, you have stuff piled on shelves, right, and everything. And I had to take every single thing out. So what he's done, like a pile of stuff in the middle of the garage, and everything's I have to put it all back together. And he's just laughing. And finally, I get him out, and he just does this little cute bouncy thing across the driveway. I'm pretty sure it flipped me off on the way out, but it was fine. Mm-hmm. Me, I was a sweaty and dusty, filthy, stressed out mess.
Yeah, there's nothing cute about a mouse. My daughter says mice are cute. She thinks snakes are cute. Nothing cute about any of them, especially if they're in your house, Lenore.
They're okay if they're like in a cage. That's right.
Or outside.
But not in my house, not running around, not the cutest thing, sitting there on the shelf, and the two of us. It was That's
right. That's right.
Nobody's blinking.
So if this is your first time watching the Resilient Advisor Show, we are streaming live on YouTube, Twitter, Facebook, and LinkedIn. If you'd like to ask a question to Lenore during a live broadcast, simply type in a comment. The system will pipe it through to me, and I'll be able to present it to Lenore. As always, Lenore sends over a lot of charts, and we run through what she's seeing in the economy. We talk about some thematic stock ideas, but today we got to start with what everybody's talking about, and that is the nonsense that's going on with GameStop. I want to start with a tweet this morning that Sean Brown, the CEO of YCharts, put out. Quite frankly, I was in the middle of trying to put out my own pithy chart on GME, and Sean's came through on Twitter. I thought, why even bother? Because Sean has nailed it here. He says the decoupling of fundamentals and market pricing is otherworldly in many cases. I remember this feeling in 1999. Lenore, what's your take on what's going on here?
I couldn't agree more. And there is absolutely no meaning to stock prices. And we've been heading this way for quite a long time. And what happened with GameStop, I mean, on Friday, it had been down from its peak in, I think it was November of 2013. It had gotten as far down as a 95% loss on its share price. And then in one day, it had record volume and it broke through to a record high share price at one point intraday on Friday. I mean, that's just insane. A lot of that, it was short covering, it was manipulated. And that's just one little example that we're seeing. But when you think about how things have been manipulated, so you've got the Federal Reserve and the ECB, they are manipulating interest rates dramatically, right? So when you manipulate an interest rate, you're manipulating the price of money. Share prices are denominated in money, right? In a currency. Well, that is so manipulated. So if you don't know the price of money, how do you know the price of anything that's priced in money? And then you add to that what's been going on with all outside the monetary stimulus, all the fiscal stimulus. And that's just, it makes no sense anymore. And what I think is really interesting when you think about what's happened with the fiscal stimulus. And let me preface this with, my God, what is going on in the economy? What people are suffering is just, it's truly mind-boggling. I mean, it's a gut punch. I can't even begin to fathom. This was not something that anybody ever imagined could happen. So it's utterly heartbreaking. But then we're handed, hats off to any bureaucrat trying to deal with this because there's no playbook on it. But what we're seeing is, for example, the number of households that actually took that money, that stimulus money, and spent it, it's actually pretty small. The vast majority of that money, like about 71% of it, went to either pay down credit card debt, understandable and a reasonable move, or it went into savings. And then if it went into savings, it ended up working its way into the stock market. And here we go again with manipulating share prices.
Or Bitcoin.
No.
The thing that gets me about...
You don't believe that meteoric rise?
The thing that gets me about GameStop, though, over the holiday season, my son won one of those new Xboxes. They were hard to find. I called some stores. There were people waiting in line outside. We're not that kind of crazy. But I thought, this is really like the last stand for GameStop because you don't need to go to GameStop. You download these kids download their videos. It's dead
Blockbuster
company.
Video.
Yes, it's Blockbuster Video. And yet it's through the roof. All right.
For no reason other than market dynamics. It has nothing to do with the stock itself, with the company.
That's right. That's right. All right. Let's move on to your macro take here. Yeah. So you sent over some charts. We're starting with some from the Fed. Your first thoughts around retail. So when you think about retail sales, everybody's been talking about, they look pretty good. Not sure where that was coming from. Given so December retail sales fell about 0.7%, so they were down versus expectations to stay flat. And November, on top of that, was revised even lower from negative 1.1 to negative 1.4. Now, more importantly, this was the third consecutive monthly decline in the headline retail sales. Even more interesting is if you look at the 3-month annualized trend, and because any 1 month, I don't really like to focus too much on that. But if you take the 3 months and annualize that trend, it's down 8.3%. Now, to put that into perspective, that's the weakest we've ever seen, barring pandemic, which changed everything. That's the weakest month trend we've seen since 2009, and it's actually worse than what we saw right after 9/11. So this is a meaningful drop in spending. Now, it's understandable when you think that the annualized trend in personal income contracted at an annual rate of about 10% if the period between August and November. So how are people going to be spending an awful lot if they're not making much money? But if you take a step back even further, government benefits now account for nearly 20% of total personal income. That's an astounding thing. So 1/5 of the money that households have in their pocket is from the government, which means that the government just took it out of one pocket and put it into another, right? That isn't wealth being generated. And about a quarter of all households have not been able to pay their monthly bills since March. I mean, how are we going to have spending going crazy if a quarter of all households can't even pay their bills? And a third of households have been forced to dip into their savings over the past 12 months. So
A third have had to dip into savings. Again, that's the destruction of wealth. And a sixth have had to borrow from a friend or family just to cover their day-to-day bills. And that's pretty profound. And when we look at the housing market, keep in mind that about 1 in 15 homeowners are under some sort of loan forbearance relief, right? Either a foreclosure or mortgage payment, that something's being held off because of the pandemic help, right? So that's the condition of the households is not so fantastic. Do you want to go in a little deeper, looking at just how bad it is for restaurants?
Yeah, before we move to restaurants, because you had a great chart on that, when you look at the retail sales, that number didn't fall as far as I would have assumed, given all the dynamics that you just mentioned. What do you think's keeping that number not so bad? As far as
there's an awful lot that we still have to buy, right? Because you think about with the economy, it's everything at the margin. So people, their lives were kind of turned upside down, right? They had to live a completely different lifestyle. So suddenly people who can't really afford it are having to get, say, an iPad or something for their child to be able to do homeschooling. People are scrambling to have to set up a home office because an awful lot of us are having to work from home and can't possibly go into the office even if you wanted to. And then people who, fortunately, there's a good portion of society that hasn't been massively hit by this. Not a huge chunk, but a good portion. And they're stuck at home saying, I don't really like this place that much. So they're either upgrading their homes or, as we'll talk about a little bit later, a lot of people are deciding to move homes to someplace where the mortgage is a lot lower, get a lot more space if they're going to be stuck at home so much.
That's right. That's right. All right. So we'll get to that in a little bit. Let's talk about restaurant sales.
Restaurants have just been, as we all know, I mean, they've just been decimated. In California here, again, all restaurants are forced to be closed. You can only do a little bit of outdoor, but mostly it's just takeaway. So restaurants who've never done a takeaway kind of service are being forced to do that. And that's awful, really, because you think about most restaurants where they make their money, it's not alcohol sales. Right? The food, the margins there are not so much. You get it on tips. So if you're a server, right, maybe you're helping get that food together and out the door for takeaway, but you're not getting the tips you used to get. And you're certainly not getting a larger check on which that tip is based because of maybe buying a bottle of wine or two. So the restaurants in December, they fell about 21.2% year over year. I mean, that's insane.
Yep.
You've lost over 20% of your income. That's incredible. We look at some other kind of dynamics that are going on. We were talking about people stay at home and they're not liking their stuff so much. So what do? Buy some more furniture. And that was going really great for a while. But like I was talking about with all of the household income, that was going really great, but now down 0.6% in December, and it's been actually negative sequentially over the past 3 months. So the people who were stuck at home looking at their couch going, I hate that thing, they bought the new couch, and that's not going to keep going, right? You're not going to keep buying new couches.
Can't do it twice.
Not when people are struggling. I mean, there was a huge spike, which was great for some of those struggling furniture companies, but that's not the impetus behind that. You need a thriving economy for those kinds of things to be sustainable. Don't exactly have that going on. Grocery stores, they were also doing great, right? Because we're all staying home, having to cook from home. So they got a big bump because they were getting money. It was taken away from restaurants and going to grocery stores. But again, we've seen where that's contracting in the past couple of months. Now, one of the good spots we've seen is, and I think we have a chart on this one, is in building materials. So, right, you're sitting at home and you're thinking, all right, I'm paying insane amounts, right? You're living in New York, you're living in one of the major urban centers, and you're paying a fortune either on rent or a mortgage, and you don't have that much space. And you're talking to your employer, and your employer is saying, you know, this whole work from home thing, maybe not so bad, because actually surveys have found that productivity hasn't been harmed at all. In fact, productivity has improved with this work from home, which is not what was expected. And employers are looking at their balance sheet and their P&L and saying, maybe we could do a little bit better because they need to find cost cutting. Maybe we don't need so much office space. Maybe this work from home thing is going pretty well and maybe we can keep it up. So people are thinking, well, I'm working from home. I don't like this home. And this home was great when I had to go to the office every day and I was barely here. now if I'm going to be working from home a lot, oh, to hell with this, I'm going someplace where it's cheaper and I get a lot more space. So home builders, they're doing fantastic, right?
Yeah. I tell you, Lenore, what I've noticed, and this speaks to financial advisors, most of the folks that would be watching this, I'm finding advisors who are over the age of 40, who always thought they needed to be in Class A office space in downtown Atlanta, Miami, New York. And they have realized over the past year, not only do they not have to be there, their clients don't care if they're not there. Their staff doesn't want to be there, and they can be just as productive and happier if they get out. And it's leading to some really seismic shifts inside of our industry.
It is. It's really interesting to see how many industries are finding, hold on, we don't really need all the trappings that we thought we absolutely needed. And like I said, productivity has actually gone up. And I think we're going to see that this shift, most companies, an awful lot of them are talking about this, even when the pandemic is just some sort of a nightmare in our past, that this work from home thing is going to stay. So most companies and most employees are saying, I want at least some degree of work from home, if not 100%, maybe popping into the office say once a month or whenever you really need it. You have more of a rotation in office space and people just pop in when they need to. Other than that, they can work from home, which is really going to change the housing market. And like you said, grade A office properties, I would not want to be anywhere near REITs that are looking at that kind of corporate office space.
Right. That's right. All right.
But home builders, they're doing really well, right? You've got home building materials have been in a very strong secular trend. And that had been happening actually before this whole pandemic started. It just accelerated. The way we saw, right, the shift to online shopping, more of our lives were moving online already. But this pandemic just made those trends that were already in place accelerate overnight. And this is another one of those trends that was already in place, but is accelerating dramatically because of it. We've seen the home builders are doing great, and home builder stocks have been doing fantastic as well, particularly if they're focused in those areas that we're going to talk about that are really benefiting from this shift to better taxes, lower mortgages, and more space.
So Lenore, a great way for me to upset my audience or pick a fight with them or get all the keyboard cowboys to show up is to say, Bitcoin might not be for everybody, or hedge funds aren't a good investment, and index investing by itself is a bad idea, and anything around inflation. Give us your take. Inflation, deflation, what do you see going forward?
Right. So the inflation trade, I think, is quite possibly one of the most overloaded trade. Everybody's expecting inflation right around the corner. And I think inflation is exceedingly unlikely. I don't even see how that's possible within the next couple of years. Right now we have a massive output gap. And what that means is our productive capacity is way beyond what the demand is looking for, right? So if you've got a factory that can churn out 100 widgets and you're only churning out, say, 70 because people are barely buying the 70, then you've got an output gap. And right now, the whole economy has a very profound output gap. And with that, when you have that, you just don't get inflation. And on top of that, you have that output gap, and you also don't have people with their wages improving much. I mean, we've seen the unemployment, so you've got an unemployment problem, and you have where there's just no wage growth. You put those two together, good luck really getting any inflation. And also keep in mind that we've got now over 17 trillion. This is just a mind-boggling number to me. 17 trillion of negative yielding bonds. That is about 30% of the share of entire world of investment grade fixed income at negative. How do you get inflation when you've got trading at negative? And don't forget how massive the amount of debt is out there. So when you have all that negative yielding debt, it makes treasury market look really attractive because the US is not going to default. Now, we can argue it's going to default through inflation in the future. Okay, fine. That is a type of default. But the US Treasury, unlike the European Union, the US Treasury can print its own money, right? So they're not going to default. They're not going to not give you your money back. And yet the yields on US Treasuries are much, much higher than a bunch of this corporate yielding, which is, again, talk about a crazy market perversion. But you've got some treasuries that look pretty darn good. Now, what I think we're going to see is that the current deflation, as that output gap shrinks, and when we get demand to stabilize, and we're not doing this, open the economy, close the economy, open the economy, close the economy. When that changes, then the inflation rate, the deflation rate, is going to we will most likely start to see some inflation. Part of that will be because you've had a lot of, not a lot, but a portion of productive capacity will have been damaged from all this. Like people are just they're gonna quit, they go home, shut down the business, we're done. But with this massive overhang of debt, and with all the destruction that this pandemic has done, you're gonna see really, really slow growth, particularly with the massive amount of debt that's across all aspects of society. You can think of that as like trying to swim with a big cement block tied to your foot. Very difficult to get the economy going with all that debt. So that means stagflation. And think about the 70s, what was going on there. So inflation, kind of bottom line, is something to keep an eye on, not something to worry about for like 2 to 3 years. Keep an eye on what's going on with the output gap, and keep an eye on what's going on with wages and the employment area.
So you had sent over in your notes some thoughts on China and their growth. Let's talk about China from an investor's perspective and an economic perspective. What do financial advisors need to be paying attention to?
So all of us alive right now in the US, well, actually, I mean, everywhere in the world, we've only known a world that was dominated by the West and mostly dominated by the US economy. The US economy was the biggest, largest, healthiest, fastest growing economy. So Americans, we think very internally. We think about investing here, and with good reason, because it was really the place to be for the most part for many, many decades. And if you think about why we were doing so well, the growth of an economy is just a function of two very simple things: the growth of the labor pool and the growth in productivity. If your labor pool is growing really fast, in the United States, the United States labor pool was growing somewhere between 3 and 5% for decades. Some dips here and there, but mostly about that. And on top of that, productivity was growing like crazy. You think about how the world was, say, post-World War II, and what it's like today, the kinds of productivity, like you and I, we can do this from anywhere in the world. We can literally be sitting anywhere. We can have this conversation. We can interact. We can buy. I mean, the ability to transact on your phone when you're in the middle of nowhere. That kind of change has really spiked up productivity. But in the US, the labor pool is down to like half to less than 0.5% growth year after year. And productivity has been really, really stagnant in the US. We haven't had that next big leap. So we haven't had that big jump in the economy. And on top of that, you have debt sitting on top, which that really makes investment. The problem with debt is if you have a bunch of debt, very difficult to have enough cash flow to go invest in the next great thing that jumps up the productivity. Now you look over at China, very, very different story. China is going through a major transformation, and it will affect the global economy. They have one of the highest, amazing level of productivity, which, put it in context, China has gone from a mostly agrarian society. Imagine taking a bunch of farmers. You go from agrarian, rural society into a modern society. Okay, the productivity to do that, the gains in productivity, astronomical. And on top of that, have a massive, massive population, right? You've got India and China, the two largest nations in the world with respect to population. So tiny little changes in productivity there because of that massive labor pool, and you're bringing more and more people into the productive labor pool, enormous impact on their economy. And right now, they're really shifting their economy to more domestic demand oriented, less dependent on exports. That's going to make their economy a little bit more stable. Like I said, no one's enjoying the kind of productivity that China has, but they're unique. They went from a rural society to modern in a very short time. And that's allowing China's influence on the global economy and the global political stage to really, really expand. And at the same time, you have a lot of the Western world, the United States, you have Europe, all kind of, they're struggling with an aging population. China has a similar problem, but they've got that productivity and a massive pool of labor. But we've got where the Western world sort of stepping back from the global stage, looking more internally, being more concerned with going on domestically. So influence is declining while China's is ascending. And if you look back historically, China and India, for most of prior to the Industrial Revolution, the two of them accounted for roughly 50% of GDP for an awful long time. So what's old is new again, right?
All right. So let's move on to some investment themes that you think are important to put eyes on at this time. So as you look at this through the lens of everything we just discussed, all the challenges we have from an economic, a macroeconomic perspective, you still see some potential investment themes out there.
I do. Yes. So looking at the market, everything looks, we were talking about GameStop, right? Everything looks insanely overpriced. It's very difficult to find anything that doesn't have a PE ratio that's, oh, well, we're in the 95th percentile of all time, which is not exactly an ideal time to go all in. But if you take a step back, look at what's going on in the economy. One of the things that's really, really rare is reliable cash flow. And as all of this debt, as we get out of this kind of emergency stance right now, because of the way the economy is, everybody's sort of hunkered down. We just got to get through it. We just got to get through it. Once the pandemic is more kind of in the rear view window, then you get a look at what's really going on. And I think it's not going to be as pretty as people are hoping. So you look for cash flow, because cash flow, always something you really want. And you want cash flow that's somewhat reliable. Well, now as much as at Tematica, we are very, very bullish on the green economy, on the renewable energy resources. A lot of that's priced pretty rich right now. Not all of it, but there's good pricing there. But one aspect that is not going away anytime soon is more of your traditional sources of energy. And with that, one area to look at is actually pipeline stocks. So the forward PE for US pipeline sector is about 17 times, which is nearly 6 multiple points below its 5-year average. Like, good Lord, where do you find anything where their PE ratio is below a 5-year average? Well, look at pipeline stocks. So if you look at what's going on as far as yield everywhere, yields are record lows, yet you have 7% in dividend yield on S&P and Canadian TSX oil and gas transport. 7% dividend yield. I'll take that. That's not so bad. If you look at the charts here that Jay's got up, there's been kind of base formation since March, and it's been continuing to strengthen. There's another little test in November, but both the short-term and the immediate momentum is actually rising, and we're seeing where the 50-day moving average is shooting up above the 200-day moving average. And relative to the S&P 500, these charts are showing a lot more strength. On top of that, when we're looking at the cash flow, right? These businesses tend to have contractual, it's a contractual nature of the business. They engage in long-term contracts, which means that cash flow, it's not, are people buying today or not? It's much more stable. So these dividends are pretty secure. And in an era where it's difficult to find anything over a couple percent, 7% looks pretty good. Now, the current yields right now are in about the 93rd percentile for the US and 97th percentile for Canadian stocks. So if that dividend yield is that high, that's telling you the dividend relative to the share price is actually pretty fantastic. It's in a rare state.
Excellent. You've got another theme for listeners and viewers as well to talk about.
Yeah, shockingly enough, apparel stocks. Because, well, I know right now my life is highly dependent on Lycra. Thank God whoever invented it, because it's just pretty much yoga sock, yoga pants and sweatshirts. I mean, I don't get to leave the house. I'm trapped. California is really bad right now. I go from either Italy, where I'm in lockdown, to California, where, I'm in lockdown.
You might need a fourth home.
Yeah, exactly. I get a little stir crazy. So, looking at what's going on with the pandemic and the vaccine rollout, that is definitely not, the UK is doing great. Everyone else is a little irritated. It's not going nearly as quickly as we were told or that we hoped for. But either way, it's going to happen. Life is eventually going to return to a different kind of normal, but not this lockdown. So we can debate when that's going to happen. But at some point, you're not going to be able to just wear yoga pants and sweats all day. And that means we're going to want to have new clothes, because another aspect of the pandemic is, well, about 70 million Americans have gained weight during the pandemic. Rates of drinking have increased as well. So have rates of smoking for the first time in many years. A recent survey out of Weight Watchers found that about 36% of people said that they've gained weight during the past year, which that puts the estimate more around 100 million. And the average weight gain was like 12 and a half pounds. So
it's not small.
Yeah, if we're gonna actually get out of the house, because those, those yoga pants are great. The sweatpants, they let you kid yourself that you've gained any weight. But if we're gonna have to go back out in the world, we're gonna need some new clothes. So that there will be an opportunity. And right now, the pricing around those are looking pretty good.
Awesome, Lenore, we're up on our time. I really do appreciate you coming on. Once again, your wealth of knowledge. Love connecting with you on your macro outlook and the themes that you and your team are researching and considering. For listeners and viewers, if they wanted to learn more about your company, where could they go?
Yeah. You can go to Tematica Research, and that's Tematica, Tematica, like Thematica, but without the H, TematicaResearch.com, or you can just follow me on Twitter and see our stuff there. That's my Twitter handle is L's Economy, ELLES, like L Magazine, Economy. Thanks a lot, Jay.
Awesome. Thank you, Lenore.